Good. Which screen is being recorded? You know?
Actually, I'm actually not sure. We can also just mirror it.
Okay. That'd be great.
Oh, can I step on there a second? Wait, I'm gonna go up the door. Huh? Yeah. No, I thought we were just walking. I drove. I need to drive it. Oh, never mind.
Where is this?
Bro, there you go.
It's here.
How many desktop do you have open, bro?
A ton. Yeah.
It's insane.
Leads many like that.
Good luck, bro. Look at that jacket. That's a 10 desktop kind of jacket right there.
Okay. Make sure I have no sus stuff.
What's
Oh, it is recording already.
up? What's up? Yeah. Oh,
Let me close the waiting room, so whoever wants to pull up can just pull up. Down just in case anyone wants to say anything. Hi guys. Hey, good to see you.
who's putting with the jackets?
Bro is fine. For the girl.
Dawson's right there. This is Chris.
One of the girls.
All right, hey guys, my name is Remy. I'm a friend of Tony's, and yeah, I guess my preface on this was that we're just going to be talking about like what happened with SVB. I'm not really too sure where everyone sits. I know everyone here is into like DeFi and stuff. So in terms of traditional finance and how banking structures work, I'm not too sure, but just in case, there's like a couple key concepts. Tony, you can just jump in whenever. But does anyone know what mortgage-backed securities are? Yeah, like mortgages repackaged into bonds and sold. Great. U.S. Treasuries, Treasury bonds sold by the U.S. government. Duration on a bond. Somewhat. Okay, so duration, for those who don't, is just essentially the time that you expect you're going to get paid back on a bond. And it also reveals the sensitivity it has to interest rate, the price of a bond to its interest rate. Which takes us to bond prices. As interest rates rise, bond prices fall. As interest rates go down, bond prices rise. That's because the outstanding bonds become more appealing if rates are lower in the market, right? The ones with higher interest. As for duration, when interest rates are low, duration tends to be low. If you think about this in terms of like mortgage-backed security, like if I'm in 2020, 2021, everyone was buying homes, everyone was getting a mortgage. The rates were like 2%, so it's super cheap to buy a house. And then what people would do is they get that, pay a little bit, then refinance, maybe a couple years later, get another loan to pay off that loan so that it's cheaper overall. But when interest rates go up, nobody's refinancing, so that duration gets stretched a lot. It goes from like maybe 5 years until the average refinance happens to about like 15. Okay. And what we're going to get into in a little bit is essentially the fact that this is really, like everyone's saying, this is a bank run caused by like insolvency. The main problem is like this bank has a huge duration problem on their balance sheet, and it led to a bank run, which was a separate issue in total. So there's two separate issues here. One is the duration problem, and then one is the bank run. Do you want to add anything here? Or?
I think you're good.
Okay, cool. So some background, so you guys are well aware of what SVB is and how they operate. They cater to startups and venture firms. They tripled in 2020 and 2021. They tripled their deposits, that is. And all these banks offer interest rates on their deposits. So you deposit your money at whichever bank is probably going to give you a good interest rate on your deposits. So that's 1%, 2%, or 3%. But in order to support paying that to the startup founders and the venture firms that are depositing their cash there, they have to make long-term loans in order to get to net the spread of the interest that they're collecting and the interest they're paying. Anyone have any questions thus far on the background on it? No. Cool. Yeah. So in order to do this, they had this tripling effect, which means they had to come up with a lot of money to pay in interest really fast. So they threw it all into long-term securities. So that is long-term treasuries, long-term mortgage-backed securities. Again, their estimation is, okay, they'll get refinanced in a couple of years, we'll get our money out and we'll get out of these long-term securities. But it doesn't, so long as we hold it to the time we get paid back, we don't actually take any losses, right? So we might get a low interest rate, and if interest rates go up, the bond prices go down, but we won't take any losses so long as we can hold them till we get paid back our money, because these aren't really bad loans. Yeah.
So then on the consumer side, are these in the form of CDs or are these all like what like asset form do these take?
That's a great question. So they're not as much CDs, and that's the problem. So a CD is essentially when a consumer goes to a bank and says, hey, I'll give you my money and I'm not going to take it out for maybe a year or two. And I'm guaranteeing that through a CD, in which case you, the bank, can give me a higher interest rate because you have my money for longer. But these are just regular deposits. So they can mature, they can be taken out anytime from the bank's perspective. So they have to keep a large amount of cash on hand in order to be able to support this large amount of deposits that could happen or withdrawals that could happen at any time, right? And especially when catering with startups, these companies have they have a high burn rate. So they're running through cash really quickly. They get a lot of money up front, then they burn through that cash pretty quickly. So they're putting it all in this massive sum, and then they're withdrawing it pretty quickly. From the bank's perspective, they're taking that money, loaning it out into long-term securities, and they don't get that money back for a while. So you can see it can start becoming more and more of an issue.
And if you look at this chart over here for folks, I mean, you guys are in the startup space and crypto, especially in the bull market. A lot of funds raised a ton of money, and then some of them bank with Silicon Valley Bank and also startups. I know a lot of people currently like in the YC cohort are freaking out about this because most of them actually do bank with Silicon Valley Bank. And so as the bull market comes, tons of money comes into startups and venture capital, and then a lot of that then Silicon Valley Bank then reaps a lot of that. So that's why their deposits tripled, and they can't like give out loans quick enough. So that's why they put all their positions into more long-term ones, where as long as you hold to the end of the 10-year maturity, like you don't take any losses there. But like in between, as it fluctuates, there's going to be unrealized losses, but you don't realize those unless you have to sell them, right? Which is kind of like what's happening right now because of this liquidity crunch. They're being forced to sell and realize those losses, and that's kind of where the problem lies.
Yeah. So you can go actually. So this really expansion happened because as soon as COVID hit, the Federal Reserve dropped interest rates to basically zero, which made borrowing money pretty much free. Like you could borrow money with 1%, 2% interest, which was like, it's not even going to keep pace with inflation. So why wouldn't you? And like the venture market exploded off this because it was like so cheap to borrow money to finance these projects. To make a return, you actually didn't have to get that much in return to get to net the spread on what you were paying in the interest payment. So the credit market just exploded. You had a lot of startups come out of nowhere, and you had all these deposits coming. Go ahead. All right, so banks are supposed to keep a certain level of liquidity on hand, especially correlated to their risk. Because if they're in more risky assets, they need to have a higher amount of liquidity at all times. But this is where Silicon Valley Bank stood. So they had a high amount of risk, and they were also loaning out an extremely high amount of their deposits. So their loan to deposit ratio was exceptionally high, especially for the risk that they were taking on. This is retail deposit share. So retail deposits are like you and I, if we were to, well, maybe not some of you guys are working in startups, but if you were to go put your money into like a JP Morgan account, like those are retail deposits. And so, I'm going to assume no one here, I mean, I don't know your situation, but if you're a retail depositor, you don't have millions and millions of dollars. You might have a couple thousand, 10,000, 50,000, 100,000, and those are all insured. So they're fine. They're insured by the federal government. So, but it's when you start getting up to those like really high deposits, like those institutions deposits, those aren't like 20,000. Those are like 5 million, 10 million, 30 million, 50 million. So those are not insured at all. And so they had a ton of uninsured loans and very little liquidity on those loans, which starts to make this problem worse and worse.
Yeah, if you look at the, go ahead.
I had a quick question. How do you classify retail deposits? Is it just everything under 250K?
No, so retail deposits, I mean, they can be bigger. It's essentially any person, non-institutional deposits. So these are mostly institutional deposits because institutional deposits are typically much larger. So retail, they're a lot smaller typically. There's actually a more of a classification for what makes someone a retail consumer. It's a little more complicated than that, but for the purpose of this, it's essentially any individual.
Yeah.
Got it. I was, oh, sorry.
Go ahead, Sean.
I was just wondering why you chose the retail classification rather than deposits less than 250K, since aren't deposits less than 250K substantially less likely to be at risk of a bank run?
Yeah, that's true. We have a slide on that at the very end too. It's just the way we put it here. Yeah.
Got it.
But that's a good point. Yeah. It's the real issue, like Sean just said, is like the amount of deposits that were in excess of 250,000, that insurable limit. So this takes us to the first of two real big issues, was the unrealized losses on the balance sheet. So as they rapidly expand, they have to invest in longer term securities to finance the interest, and then interest rates start to go up in 2022 rapidly. This is the quickest the Fed has ever increased interest rates, or in the past at least like, I don't know, 50 years or something, since essentially the 1970s, 80s. So they were raising interest rates really, really fast, causing all of these long-term loans to be worth 70 cents on the dollar. So their portfolio of loans took a massive hit, but it was all in unrealized losses. Now, when it comes to accounting, I'm not sure who has accounting experience and who doesn't, but you don't actually record these losses on the balance sheet because these losses are recorded in their held to maturity assets. Essentially, they don't intend on selling these assets. They intend on holding them until they're eventually paid back. So this $15 billion of losses was essentially on, it was not recorded on their balance sheet. It was deep in the 10K and investors did not catch it. So, and what happened was, as you start to look at the equity value of in Silicon Valley Bank, it was worth about 16 billion. So after accounting for these losses, the equity value was almost completely wiped out, which we actually have another slide on. But as we mentioned before, duration, when these interest rates spiked, rapidly increased. The price of the bonds went to 70 cents on the dollar. And yeah, go ahead. You can go to the next slide. Oh, this is the effective federal funds rate. This is what really matters right here. I don't know if you can see it, but it spiked very, very high. You can go to the next one. Okay, yeah. Any questions on this so far? No. Yeah.
Can you jump through with like how the federal funds rate relates and what this means for mean rates moving forward? I mean,
oh yeah,
versus
sure.
interest rates,
Yeah.
or does that have any other implications?
Yeah, that's a great question. I'm gonna actually save that for in a slide or so, because that's a really good point. Like, what can the Fed keep raising interest rates? That's a huge question now. And the short answer is they can't really keep raising interest rates unless they want the system to break. So the burn rate causes these withdrawals, and then this causes a liquidity crunch. So what happens is SVB goes, okay, we're starting to have liquidity problems. We need to liquidate some of these longer term assets that we had. As soon as they liquidate those assets, the loans that are outstanding get what's called mark to market. At first, they're essentially recorded as $1 for one loan. It's not $1 for a loan, but it's for this example, it's $1 for one loan. And as soon as you sell it, it gets recorded as the actual market value, so 70 cents on the dollar. And so once that took place, they had to raise capital and they start selling these loans. The market goes, oh shit, these banks are way overvalued. Not just Silicon Valley Bank. There was about $620 billion of unrealized losses in across the board for different banks. So Silicon Valley Bank, though, when you took into account the shareholder value and the losses, it completely wiped out the shareholder value, as I said. So it caused a fire sale of the stock. And on March 9th, it dropped 65%, halted trading the next day, and that sparked the next bank run, especially as all these founders became worried that they're like, oh shit, this bank is insolvent. I'm not insured. We got to start pulling our money out. And I'm sure, as you guys heard, YC was telling them, pull your money out. Everyone was telling them, pull your money out, which just exacerbates the problem of a bank run. You can go to the next slide, Tim. Trey, do you want to add anything? Or
I'll come back to this.
Okay.
Yeah.
Oh yeah, this is okay. So this is actually a pretty interesting slide. This is the impact of those unrealized losses. So for most banks, it's not a huge issue. It will cause a revaluation of the equity in those banks. So that's where you saw the 10% off, the 6% price drop in all these bank stocks. But it's not like critical. For Silicon Valley Bank, after you took into account the unrealized loss, it was essentially the equity was wiped out completely. So it would have gone to zero if it was continuing to trade. Yeah, you can keep going. Yeah, so the banking system is completely. Yeah.
So is it because Silicon Valley Bank had put all their money in the bonds? That's why they got wiped out versus other banks maybe get better.
All the banks put it in that, but like I would say like Silicon Valley Bank had a larger percentage like in specifically those, because that they saw the quick deposit rises in 2019 to 2021. Yeah,
that's a great question. So larger banks actually have to keep a larger amount of capital. They have to have higher liquidity ratios. Silicon Valley Bank, because they were expanding in 2020 and 2021, they issued all these long-term bonds in 2020 and 2021 when interest rates were like zero. So other banks took losses, but they took really heavy losses rather, because JP Morgan has been issuing bonds for years and years and years.
So it's both the timing that they issued and the fact that they have a lot of things.
Exactly. Yeah.
Did you want to talk about like how this didn't have to happen, but also like it's the communication timing of like the communication having to raise equity?
Yeah, so they actually had, this is something that's more on the edge of where I understand, but they actually had a lot of liquidity pools that they could have tapped into. They did have some liquidity problems, but they were able to make it back. They were able to take a lot of loans. They could have themselves taken loans. I don't think that they anticipated that when they sell, that the market is going to react like this. So as soon as they sold and realized those losses, the markets recorrected, and that caused the bank to essentially become insolvent. In a couple of days, what I was reading is that they actually would have had a couple of these loans maturing, and they would have had access to a lot more liquidity. If it was postponed just even like a week, they would not have had this issue. Yeah.
And you mentioned just like market recorrection. What does that look like exactly?
So the market is essentially pricing in the value of their equity relative to the total balance sheet. So once these unrealized losses were realized, they were like, oh shit, our equity value is wiped out by these losses. So they sold because it wasn't what their expected value was.
Yeah. So obviously the unrealized losses are about the balance sheets, but how did like no one pick up on like this big amount of them?
That's a great question. Some people did. They had it was 5% short, but it wasn't known to the general market. You would assume so. I think a lot of people probably, if you dug deep enough in their 10K, it was there. You could see the unrealized losses. But I think people are like, oh, these are held to maturity assets. Like they're going to have them for a long time. So long as they hold them to maturity, they're not going to take these losses. So now I don't think anyone expected that they would have this liquidity problem, be forced to sell, and then realize all these losses on top of it.
And all the other banks have this too, right?
Yeah.
So it's like people assume that this is just normal, right? But then like only when you push it to the extreme, then like when you're forced to sell, then you have, yeah, so.
What do you mean by 10K?
Their annual, sorry, their 10K, a company's 10K. A company has to report, any publicly traded company has to report all the financials and all their business information through the SEC, which is the Securities Exchange Commission. And it's filed annually in this report called the 10K. Okay. So it's essentially an extensive report on all their operations, their management decisions, their financials, their balance sheet, their cash flows, everything.
You can find it on SEC. So all public companies are forced to, I guess, essentially give investors as much data as possible, right? So on this, you'll usually see like things like the balance sheet or their income statement, their cash flow, and they'll report like kind of their strategy, right? So investors would typically like look at this. This is where like a lot of the analysts like take their data from to be able to give you projections of how much they expect the equity is worth. Right. So, yeah, the SEC forces them to report on this stuff. So
if they're going to be public. Yeah.
So like you can look at like that.
Yeah, actually pull it up. Pull up their balance sheet. Now this, I'm not going to get super into accounting, but
where do you see the unrealized loss portion, by the way?
It's not in here. That's what you'd control that bit. It's down.
Right.
It's in the notes. So it's essentially like deep in the notes that you would have found that they have all these losses on their balance sheet.
Right. So this is like their cash on hand, their let's see, unrealized. It's a big document. I don't know if so.
Anyways, any other questions? Yeah.
Can you explain what you meant by like custodian by the?
Yeah, so these banks constantly have loans maturing as time goes on. And they do that intentionally so that they constantly have access to cash in the case of withdrawals.
Right.
They actually did have loans maturing in about a week's time. And so they would have had access to a lot more liquidity had they just been able to postpone. So
I think this was filed February 28th. And like here they talk about it, right? There, for instance,
they show it though. If you go down, they should. Okay,
look at this real quick. Right. For instance, increases in the interest rates have resulted and may continue to result decrease in the fair value of what is this again? Available, yeah. Fixed income investment portfolio, increase in the price frequency proportion of interest bearing deposits, while unrealized losses to our hold to maturity fixed income investment portfolio may make it more, costly or less likely, right? So this is like one of the key risks. Where is it?
If you just put in unrealized losses.
All right.
And then just keep going down. Keep going down. Wait. Yeah, right here. So right here. They have all of their, where's this? Here we go. Okay. So as of these are comparing 2022 to 2021. In 2022, in 2021, they had 304 million of unrealized losses. This tripled in 2022. They had over $1 billion of unrealized losses. More than that actually, but yeah, so you get the point. They lost a bunch of money on these loans. They had to realize those losses as soon as they sold. Yeah.
Yes, you mentioned that they could do something like, instead of realizing losses, they can take it out of someone else. But would that just, put down the problem? Because I'm assuming you're going to take like a high interest loan.
Yeah.
Have, like, no interest.
Yeah.
Well, so how does that turn out?
That's exactly right. A lot of times they'll have access to short-term loans. I'm honestly not too sure why they didn't at this point. It could have been the fact that they exceeded their liquidity limits and they were no longer able to access that capital. But yeah, and taking a loan right now is super costly. That's why they do it, is to slow. The Fed raises interest rates to slow the credit market down so that people don't have access to money as easily. So, and they do that to slow the economy so that they can slow inflation, right? So, yeah, to borrow now, you're going to take a 5% interest rate, whereas borrowing before 0%, right, or 1%. So, yeah, okay. So this is the key part. So this is the second issue, the bank run. So the loss of confidence in SVB caused everyone to pull their money out, which led to a bank run. Now the fear is that this could be the tipping point of like a domino to lead to other dominoes. The unrealized losses, all these banks have them, but that's not a huge problem. That's just a revaluation. So people might sell their stock sells off 5-10%, but it's not this. A bank run is when everyone rushes to the bank to pull out their money, and no banks have the amount of money of their depositors on hand. They loan it out, right? That's how they make money. Now, as was mentioned earlier, the FDIC, they're the insurance corporation that insures all depositors up to 250,000. Whereas most banks, actually, Tony, can you go to I think it's the last slide, the very last slide. Okay, it's kind of hard to see. Silicon Valley Bank is 99th out of 100 for amount of deposits that were insured. They had less than 3% of their total deposits that are insurable, compared with a lot of larger banks that have 50%, 30%, which is very different. So it causes a lot more panic when it's so low. But if SVB collapses and then Northern Trust collapses above them and First Republic Bank collapses because all these banks have a high amount of unsecured deposits, uninsured deposits, then it can just keep spiraling upward to getting towards these big banks and some larger banks. On top of that, I don't know if any of you bank with Wells Fargo, but on Friday they had a glitch, which was like, I don't know if it was a glitch or like something materially wrong with the actual bank, but it was essentially saying that the amount in your account might not be might not be what's actually in your account. And so everyone got kind of like scared, shitting themselves just because it's like, what the fuck, what's going on here? So, but I don't know, Wells Fargo may have some issues, they might not. It's hard to say. But yeah, the bigger fear was that this could knock down many future dominoes. And if that were to happen, we could see a massive, massive banking infrastructure collapse. Because we work on fiat money, which I'm sure you guys are all working to get us off of, because we're operating on fiat currency, everything revolves around trust. The entire banking system is predicated on trust. So as soon as that trust and that confidence is lost in the banking system, the whole thing crumbles. Like the entire thing breaks. So it becomes a really, really big problem. And that's why I broke them into two issues. One is like the balance sheet issue of liquidity and unrealized losses. The second, and it's more fundamental, is like a credibility and confidence issue, that people lost faith in the system and they start withdrawing. And the bigger problem is that, even if everyone's checking their bank accounts, and anyone who has over 250,000 in a bank is saying to themselves, oh shit, I got to get within these limits. So I got to spread my money out so that I'm at 250,000 per bank, which is how these insurance things work. Just that in itself could cause another bank run. So if that were to happen on Monday, then we could see much more of this happen. But we're going to get to, because there was a press release that changed a lot. You can go back quite a bit.
Right here.
Oh yeah, was that the last slide?
No, this is the
No, I know, but before that,
right.
let's see. Oh, this was kind of crazy. So on Friday, the bank completely stopped trading. The FDIC swooped in. This took place over one day. They dropped 65% by 10 a.m. the next morning. The FDIC swooped in, seized the assets of Silicon Valley Bank, and made a statement saying, hey, if you have money here that's insured, we're going to get you your money by Monday. If not, we're going to sell the assets and you'll get the residuals of whatever's left, which wouldn't be much. So in this, up until about 30 minutes ago, or an hour ago, I guess now, there was a big fear. All these startups, all these companies that were banking at SVB lost everything. If they didn't get their money out in time, and they would have gotten back a nice little $250,000 on their 10 million or whatever. Like it would have been massive. They all have payroll, right? So they have payroll Monday. They don't have cash to finance their working capital. So they rely on this venture money. So they had to tap into those bank accounts and they don't have it. So all it could have caused just a ripple effect throughout the entire economy, essentially saying that Silicon Valley Bank went out of business. Now all these startups go bankrupt because they can't afford, or they take massive, nobody gets paid. Yeah, it would have caused some real serious problems.
Yeah, I was just talking to my friend right before this. She like raised her seed 2 months ago, and like she was banking with Silicon Valley Bank. So basically, this happened. She was like, "Wow, like all of that just disappeared." And then when she found out the message that they were gonna insure more than 250K, it's quite a sigh of relief. Yeah, and then I was talking to another one of my friends who's currently in like Y Combinator's cohort. Like it seems like a lot of the startups, that come out of there do bank with Silicon Valley Bank. So that's why, like, there was an immediate like at least immediate petition to try to, get the Fed to step in, which they did just about an hour ago.
Yeah. So it's crazy because you asked me an hour and a half ago. Yeah, what's up?
Oh, there you go.
Go ahead.
So, like you were talking about there possibly being like a domino effect. If that were to happen, is there like a time, like a time scale you could give for like how quickly that could take place?
It would happen immediately.
Like immediately on Monday.
Yeah. It would happen almost instantaneously.
So everybody's kind of just waiting to see what happens tomorrow.
Yeah.
Yeah.
Well, so that takes us to the last part. If you would have asked me an hour and a half ago, because this is a confidence issue, the Federal Reserve needed to come in on Friday and say like, hey, we're going to back this up. We're going to do whatever it takes to not have any more bank runs, but they didn't. Thankfully, like 30 minutes before we got here, they issued a statement essentially saying that they're going to work with all the uninsured depositors of Silicon Valley Bank to reimburse them all and offer emergency line of credit to any person who has to any bank who has liquidity problems for meeting deposits or withdrawals. Sorry. So with that, I don't know what this is going to look like. This is all we have right now. Is this going to be enough, or like could be? Will this reinstate confidence? It's hard to say. I don't know how many people banks could still have a bank run. It's really hard to say if they're going to be able to reinstate confidence. Again, I think they had to do this on Friday, but they didn't. They just did it today. So we'll see.
Is there any, like, you were talking about line of credit, right? Something is like the difference between long-term debt versus like short-term debt. Long-term debt would then be like bonds, right? Ones that are held to maturity. Short-term line of credit, it's just in really quick and dirty. You get something to be able to pay right now whatever working capital you need. For example, paying payroll. For example, if people want to take their money out right now, but like usually, a short-term line of credit isn't enough if everyone in the bank wants their money back, right?
Yeah, it's going to be really hard to support.
Right.
So we'll have to see. But to your question, that's a great question because had they not said this, it would have happened almost immediately. Because the way bank run, I mean, we just saw a bank go down in a day, right? They realized the losses on Wednesday, stock down 65%. Federal FDIC takes control on Friday, so literally goes insolvent in one day. And because of the nature of bank run, where everyone rushes to get their money out, which causes everyone to rush to get their money out because you don't want to be the sucker in the back of the line. So it's basically a pushing and shoving contest to who can get their money out.
They did try to get bought out, like they try to sell their equity.
They did.
Right.
Yeah, but it's a really big confidence issue. So it's going to be really interesting to see what comes next. If this is enough, then maybe they can prevent bank runs. If it's not, then can they support all these bank runs on smaller banks? I don't know. Yeah.
So this line of credit is just that when people come and ask for their money, the FDIC will give the bank the money.
Yeah, the Federal Reserve would provide these banks with a line of credit to be able to borrow money from the Fed to be able to give these people their money.
So they're able to handle like a level of bank run, but everybody.
Exactly. It's hard to say like how. I mean, they're the Fed. They can print money, so it's hard to say like just the extent of how far they're willing to go to protect these banks, especially small regional banks.
Banks want to essentially lend out whatever deposits they possibly have. That's how they make their money, right? But then there's a limit for how much like cash reserves you have to have on hand, such that if there are people who want their money back, you're able to. So it's like if you go to the bank right now, you ask for your money. If it's a large amount, let's say I want to take my entire account out, right? They can't just give it to me immediately. They have to wait some time to be able to do that. So they have cash reserves to be able to support that. But if like more, it's only to a certain extent, right? They predict, okay, like this is usually how much people will take out. I'll have enough cash reserve to be able to cover that. Usually the government sets like a limit for that. And then when there's situations where there's like a loss of confidence, people want to take it out, it goes above that. So the Fed is coming in to say, okay, if there's a little bit of above that limit, we'll support that, right? And that's essentially to give the public confidence that like if you want to get your money, you'll get your money back. Because it's otherwise it's a downward spiral effect, right? Like if people go there's not enough, then everyone wants to take it out. Then essentially like it'll hit its curve.
Yeah. No.
What was it, 65%?
Oh, their stock dropped 65% on Thursday. So yeah.
How's it different to a bailout?
That's a great question. It's not. It is a bailout. But they're basically saying that this is not a taxpayer bailout like it was in 2008, where they just gave all this money to these banks paid by taxpayers. That was a Treasury Department bailout. So they got money from the US Treasury, meaning that we paid for it. In this case, they're offering a line of credit to the banks. So it's a bailout, but the tax is in the form of inflation. Right now, we're trying to tighten the money supply, and we just saw what happens when it gets too tight, right? These banks have no liquidity. Bank runs can be possible, and this can happen, right? So it puts the Fed between a rock and a hard place. And this to your question earlier, which was about like, how does this affect interest rates going forward? Can they keep raising interest rates now that we just had a bank run? It's really unlikely because, and what they just did, they offered in this note, they're saying, we're going to keep printing money to support these banks, essentially.
I think they use they say they're not using taxpayer money, they're using the exchange stabilization fund. Saw a thread on Whitepaper Circle channel where someone was talking about it. I think like it's something that the banks pay in, all the banks pay in, and they're using that fund to make the depositors whole.
Yeah. So regardless, what this does though is it injects more money into the system, more money into circulation to provide liquidity to these banks, which they have to do, which more money in causes more inflation. So it's like they were trying to bring it down, and now they have to lighten up on those brakes, even though we're not even close to bringing down inflation. So regardless, we still have some really big problems, especially with inflation. Yeah, what's up?
So technically, couldn't the Fed have just decreased interest rates to the point where like people won't be as scared of like losing their money? Like, so because if you lower interest rates, then the bonds are sold with more, and then people wouldn't be as like worried. Then we can wait a week, and then Silicon Valley Bank can also wait till their loans come to maturity. So wouldn't that solve the problem?
Yeah, but interest rates take a while to like actually trickle into the economy. So the Fed doesn't actually set the interest rate. They have a target rate that they try to achieve. And they achieve it by essentially putting more money into the system or taking more money out of the system. As they take more money out, interest rates go up. So they set a target rate, which is the federal funds rate. It's the interest rate that everyone refers to. So in theory, like if they would do that, it wouldn't be like a short-term, that's not a short-term solution, right? They would do that if there was like some serious problems in the banking sector. We're in a really, really hard recession and they need to stimulate the economy. They would lower interest rates. But again, they can't really do that right now because they're still trying to bring down inflation. And there's a ongoing theory, it's an old theory and it's been true across time. That in order for inflation to really come down, you have to get real rates, which means you have to get interest rates above the rate of inflation. And right now that is not the case. We're not there yet. So they have to keep raising rates to even get that point. But they can't raise rates because they'll break the system. So it's like this really weird situation. And it's a very macro level problem. this is like a more micro, like there's bank runs and, you know, it could lead to a macro problem. But from the Fed's perspective, they also can't start printing money to bail out these banks because that goes against everything that they've just been doing. And they're not in a place where you're able to do that.
Isn't this like solution that they're doing, doesn't it potentially have like a lot of implications to it?
Yeah.
For example, like let's say a bank needs to take a line of credit to like pay back their depositors, then they go under, they can't make that credit payment back to the US government. And then the money's just out of the fund. Like,
Yeah, I mean, they still have loans on their balance sheet. Like they do have money coming in. The problem is it's not fast enough
okay.
for them to be able to meet these deposits or these withdrawals. So, but it could definitely, I mean, look, if this led to like a large scale recession and the people that they loan money to can no longer afford the payments on their loans because we're in like a really bad recession and all these loans start to default, then you have like a much more escalated problem. You have all the loans that was used as collateral basically worthless. So that could happen, but I think that's at least not likely. That's more of a long-term issue. That would take a little bit longer to actualize.
This is a good time to talk about the working capital cycle. So it's like banks, right? You have people who pay you interest and you collect interest from someone, right? And these two happen at different rates. So I have to collect from this to give to the other person, right? And so between when I get paid and when I pay someone else, that is your working capital cycle, right? Amount of days where like you essentially have an imbalance, you need liquidity, you need cash. And that's usually when a company in a traditional sense would take out a line of credit in order to bridge that gap, right? So you know, maybe let's not talk about a bank, let's talk about a company that sells I don't know, electrical components. So you have people that you are buying materials from, you're buying components from, and then you build that product and you sell it to someone, right? It takes some time for the person that bought it from you to pay you before you can actually pay your suppliers, right? But the thing is, like when you're building these things, you have to buy from the suppliers first. They want the money. So between when you pay the suppliers versus when you actually get money from your customers, that's like the difference between the working capital cycle. There's also like inventory days for how long you hold it. Essentially, like how do you like the amount of time it takes for you to convert it into cash, and then between that cycle, that's what you usually fund with a line of credit from the bank. Yeah. So you can kind of apply that same analogy from the bank, right? They have these long-term bonds that have very long durations, long maturity rate, but they have a lot of like very, very quick short-term needs for cash, right? So how quickly the money is coming in is not able to support the amount of money that's like the rate in which the money is going out. So in that scenario, that's when you need to borrow more money to be able to support the amount of money you need to go out.
Yeah.
Right.
Awesome. Yeah. So I think the question is like, what's next, right? Like what happens after this? What happens on Monday? It was pretty clear before this statement. Now I'd say it's pretty unclear. I mean, it really depends on how the market reacts to this. Like you said, I have a hard time saying they're like, we're gonna offer this free to anyone who wants it, any bank who needs help. There's going to be contingencies on this, and what this looks like in practice, I have no idea. They have not released that information yet. So we just know like, hey, they're there, and it's really to reinstate confidence. Is it going to be enough to get people to have confidence and faith in the system? That's the big question. So on Monday, we'll know pretty fast if